Components of bond returns. Welcome back. To master the bond market, one must look beyond the gross yield and understand the net return. A bond's total return consists of two distinct components: interest income and capital gains or losses. Interest income is the periodic cash flow you receive from the issuer, while capital gains or losses occur if you sell the bond before its maturity date for a price different from what you paid. Crucially, these two components are often taxed at different rates. For a serious investor, the net return, the actual income you keep after satisfying the tax authorities, is the only true measure of investment performance. As the slide illustrates, we must analyze interest income and capital gains or losses separately. Because of their different tax treatments, calculating the net return is the most important step in evaluating a bond. As a trainer, I always tell my students, a bond with a high interest rate might look attractive, but if the tax on that interest is significantly higher than the tax on capital gains, you might actually be better off with a lower coupon bond that has more potential for price appreciation. Taxation of interest income. In most jurisdictions, interest income is treated as ordinary income, meaning it is taxed at the same rate as your professional salary. However, certain bonds offer a tax-exempt status. For example, U.S. municipal bonds are often exempt from federal and some state taxes. This creates a significant difference between gross and net payments. High net worth individuals often prefer these tax-exempt securities because, while the nominal yield is lower, the after-tax yield can be much higher than a fully taxable corporate bond. You must always account for your specific tax bracket when comparing these two paths. The slide highlights the difference between ordinary income and tax-exempt securities. The choice between gross vs net payments is a strategic one. As a professional, you must help your clients understand that their tax bracket is the primary filter through which they should view the bond market. For someone in the 40% tax bracket, a tax-exempt bond is a powerful shield that preserves wealth, whereas for someone in a 10% bracket, the tax-exempt status might not be worth the lower starting coupon. Capital gains and losses. When you trade a bond prior to its maturity, you trigger a capital gain or loss. This is calculated as the simple difference between your sale price and your original purchase price. Tax authorities often distinguish between short-term and long-term gains. In many countries, if you hold the bond for more than 12 months, you qualify for a much lower tax rate on your profits. Some global jurisdictions even choose not to implement a capital gains tax at all. This creates a tactical opportunity. Sometimes it is more profitable to sell a bond and take a lightly taxed capital gain rather than waiting for the heavily taxed interest coupon. The slide details the mechanics of sale prior to maturity. We see the calculation of the price difference and how tax rates change based on the holding period. As a trainer, I suggest you always watch the calendar. Selling a bond on day 364 versus day 366 can mean a massive difference in the tax you owe. Mastering this timing allows you to use the tax code to your advantage, ensuring that a larger portion of your market success stays in your investment account. Original issue discount, OID. We must pay special attention to original issue discount, OID bonds, such as zero-coupon bonds. Since these bonds pay no regular cash interest, the difference between the low issue price and the par value is treated as implicit interest. Tax authorities typically require you to report a portion of this gain as income every year, even though you won't receive the actual cash until the bond matures. This creates phantom income, where you are paying taxes out of your own pocket on money you haven't technically received yet. This is a vital cash flow consideration for any bond portfolio. The slide defines OID and the concept of implicit interest. The tax provision creates phantom income, which requires careful planning. As an analyst, you must warn your clients about this. If they invest heavily in zero-coupon bonds, they need a separate cash bucket to pay the annual tax bill. Even though the bond is growing in value every year, it isn't putting cash in your hand until the very end, and the taxman isn't willing to wait 10 years for his share. Cost basis adjustment for OID. To ensure you aren't taxed twice on your OID bonds, the law allows for a cost basis adjustment. Your cost basis is the value of your investment for tax purposes. Each year, as you pay tax on that phantom income, your cost basis increases by that same amount. By the time the bond reaches its maturity date, your adjusted cost basis will exactly equal the par value. Because your tax cost now matches your redemption amount, there is no capital gain tax due at maturity. You have effectively paid the tax in small annual installments throughout the life of the bond. The slide tracks this cost basis journey. Through the annual step-up, we reach a point at maturity where the basis equals the par value. This leads to the result of having no extra tax due at the end. As a trainer, I find this to be a fair, albeit complex system. It recognizes that you've already settled with the tax office for the bond's growth. Understanding this, accretion of the cost basis is essential for accurate tax reporting and for calculating your final total after-tax profit on the investment, premium bonds, and amortization. On the opposite end, we have premium bonds, which are purchased for more than their par value. For these, the tax law often provides a benefit through amortization. Investors may be allowed to deduct a prorated portion of the premium they paid each year. This annual deduction reduces the amount of taxable interest income you have to report, effectively lowering your tax bill today. However, this also means your cost basis decreases every year. By maturity, your basis will have dropped down to par, reflecting the natural price decay that happens to all premium bonds as they approach their redemption date. The slide defines a premium bond and the process of amortization. This provides a tax benefit by reducing reported income while the cost basis gradually decreases. As a professional, you should look for premium bonds in high-tax environments. While they might look expensive at first glance, the ability to write off that premium against your high-tax interest income can make them much more profitable on a net basis than a bond bought at Pearly. Global tax variations. Finally, we must acknowledge that location matters. The global tax landscape is a patchwork of different rules. For instance, while the US requires annual tax payments on OID bonds, countries like Japan may have much more lenient rules. Furthermore, Eurobonds often make gross interest payments without any withholding tax, making them very popular for international investors. Some countries may tax capital gains at 20%, while others might have a 0% rate to encourage investment. You must always consult the specific tax treaty between your home country and the country of the issuer to understand your true return. The slide highlights these global tax variations. We see that OID rules and capital gains tax vary by country. Eurobonds are noted for their gross payments. As a trainer, I want you to see that in a globalized world, tax arbitrage is a real strategy. By choosing to invest in a jurisdiction with more favorable rules for your specific situation, you can significantly enhance your investment outcome. Always do your geographic due diligence before moving capital across borders. Summary of tax considerations. To summarize, fixed income taxation is built on two pillars: interest and price changes. We've learned that OID bonds create phantom income but allow for a cost basis step up, while premium bonds offer an amortization benefit that reduces taxable income. The ultimate goal for any investor is the net return. You must always calculate your returns after tax to evaluate the true performance of your portfolio. By mastering these rules, from OID accretion to premium amortization, you can ensure that you are making the most tax-efficient and profitable decisions in the global bond market. Our final summary map brings it all together. We analyze the two return types. We follow the OID rules for phantom income and cost basis. We use premiums to reduce taxable income. And we always focus on the net return. As a trainer, I hope you leave this session understanding that tax is the unseen force that moves the bond market. By applying these considerations to your analysis, you can see the true value of every investment and build a portfolio that truly serves your long-term financial goals. Thank you.